So the one thing is there was a bank collapse. Okay, Lehman went bankrupt. Lehman, bankrupt. What other interesting things happened in the world of finance this weekend? There's two other things I think were interesting. What happened to the price of oil? Okay, oil went down below 100. Oil is less than now $100 a barrel for the first time in a long time. And what was the third thing that was interesting in the weekend? What? What? Merrill Lynch will put them in the Lehman stuff. They're not any more interesting than that. What else was interesting? What happened relatively close to home, as I understand it? That in China they lowered interest rates. Is this correct?
Yes.
So interest rates in China. Okay? So let's see if we understand what all these things are. Okay? Because and if there's questions, this might be interesting. So a bank went under. Okay? First of all, what does it mean for a bank to be bankrupt? Something to be bankrupt. Okay? We'll actually be talking a little bit about how you would compute the probability of something going bankrupt in a few weeks. We'll get around to that. But basically, this means that you had a company that had a certain stock price, okay, a certain amount in stock, okay. It had a certain amount of stuff that it owned, and then it also had more in the way of debt than it had before. And so somehow the total value of the stock of the company plus what it owned was less than what it owed other people. So it collapsed. Now, normally, an individual collapsing is not really any concern, okay? But the big problem is this is a big organization that owes a lot of money to other people. Remember how we talked about margin calls and things like that? There are all these mechanisms put in place so that if one bank were to, if somebody else is losing money, okay, they will be able to meet their obligations. There's a way to make sure they will meet their obligations because they have all the collateral and all this kind of thing, right? And so normally if somebody else loses money, I don't care. But if somebody owes more than they had at the time of collapse, this upsets the markets because now you've got other people who've made deals with these people and they're less certain about being paid, okay? And they're less certain how much they're owed or not be owed. And that is one reason why everybody is unhappy at this moment. Any questions about that? Okay? Another thing that happened was a commodity thing. We talked about the price of oil. Okay? The price of oil dropped below $100 dollars a barrel. Okay? Does anybody know why the price of oil is dropping? Okay? What is it? Okay. What would, question?
The market will worry about the demand will fall.
So they're worried about demand falling, or basically it's a supply and demand thing, right? Why are people needing less oil now than they did before? Okay, does it taste any different? What is the reason? Okay. Why? Let's anyone think about a reason why suddenly people might be worried that people are not using as much oil as before. Okay. Any ideas? Okay. So one argument is that as the markets, as business gets unhappy, okay, business is going to be doing less things, right? Okay. There's fewer people flying on planes, fewer business people soon to be flying on planes when they lose their jobs because the banks went out of business. But a bigger problem would be as people are buying less and less stuff, manufacturing companies which use a lot of oil to ship things and to make things and stuff like that, they are making less stuff. Fear is that they're going to be factories around the world are going to need to make less stuff. They're going to need less oil. And if there's a lower demand as the world economy drops, prices will drop. Okay? That's the basic reason oil is dropping. Any questions about that? Okay? And the other thing that we saw in the news this weekend was that China, okay, the interest rate in China went down. Is this correct? Okay. Now, why did the interest rate in China go down? And it's a little different with China than with, let's say, places where currencies are freely traded and all this kind of stuff. But why did the interest rate in China go down? Does anyone have an idea? Okay. Presumably it went down because China wanted it to go down. Okay, that's one reason. Why did China want the interest rates to go down? Anybody have any ideas?
Save the stock market.
So what do you say?
Save the stock market.
You say to save the stock markets. Okay.
Companies.
What is it?
Save small companies.
Save small companies. Okay. My understanding, again, remember, you're getting this from a computer scientist. But nonetheless, what is happening here? Okay, in China, there is a concern, governments have concerns between two kinds of things that happen in a country. One is inflation, right? Inflation means that your dollar is going less because prices are, your money is worth less because prices keep going up. Okay? Another is unemployment. Okay? People that don't have jobs, there's less activity going on in the country, people get fired, there's less jobs, and people are unhappy. Right? Up until recently, China was growing very, very fast. And because it was growing very, very fast, one thing that happens when things grow very fast is inflation goes up. We'll talk a little more about interest rates and inflation a little later. Now there is less concern in China about interest rates, about inflation, and more concerns about the slowdown economically. Okay, that people are making, the factories are getting less orders. There's less jobs potentially available, less work available. And by lowering the interest rate, that can do a couple of things. One is, it can convince companies, your little company, let's say, maybe wants to borrow money to start and do something. The lower you make the interest rate, the more interesting people are to do that. Does that make sense?
Yes.
The other thing we have noticed is that there's a relationship between the interest rate that a country pays and what the value of its currency is. Remember that?
Yeah.
So changing one is changing the other. Okay? And the lower the currency rate is, the better it is for you to make exports because everything looks cheaper. Okay? And that's sort of one of the other factors that comes in here. Any other questions about the state of the world or anything like this? Okay, any other economic news? Does that explain the state of the world adequately? Okay? Fair enough. I want to talk about one company today, though, before we get into the real part of the lecture. We talked last time about, about commodities. Okay? And I don't really like to talk too much about commodities because they're, in some sense, related to the kind of securities that we talk about. They behave in some ways like we talked about before. But they're also messier to deal with. And that was one of the things I think that happened in last lecture, was that there's some messiness, things that come when you're dealing with physical objects and things like this. And I wanted to talk about one example that might have made some of the things we talked about last class a little clearer. If it doesn't, from this point, we'll probably drop commodities. But I just want to talk about it a little bit. But it has to do with a commodity called a Big Mac. How many people here are familiar with a commodity called a Big Mac? Raise your hands if you are. How many people have never heard of a Big Mac? Okay. It is a type of sandwich that is offered by McDonald's. How many people are familiar with McDonald's, right?
Yeah.
Okay.
I don't like
So, what is interesting about Big Macs? There are several things that are interesting about them. One is that they are, in some sense, commodities around the world. I don't know how much traveling many of you do, but when you go into a McDonald's restaurant in France or Germany or China or any place in the world, a Big Mac is supposed to be exactly the same thing. It is 2 all-beef patties, special sauce, lettuce, cheese, pickles, onions on a sesame seed bun. Okay? So as a commodity, though, now what do we know about commodities? Commodities, if they're all the same, okay, they should be somehow able to be traded in some sense. Okay? And that we should be able to know something about the prices of these kinds of commodities in different places. Well, one thing that's kind of interesting and amusing is, on the left column of my table, I show you what is the dollar price, okay, of a Big Mac, okay, in each of the following countries, okay? In the United States, it will cost you $3.57. If you go to the local place on campus here in Hong Kong, and you convert your things to dollars, it apparently will cost you about $1.71. Okay? Why is the price of a Big Mac cheaper here than back in the United States? Okay? Is there a good reason for that?
Materials and workforce is cheaper here.
One argument might be that it has to do with materials and workforce. Okay? One argument might be that it has to do with currency being undervalued. Okay? That if we assume that, let's say, a commodity is a fixed thing, okay, it should cost the same somehow in all different countries. Okay? And that this might be one way of measuring whether one currency should be higher or lower than another. You sometimes hear that issue in modern economic talk. Okay? Any questions about that? Okay? But the bigger question is, for the purposes in our class, given that these are the real prices of Big Macs in all these different countries, and given that they are commodities, one is the same, why isn't there an arbitrage opportunity? Okay? What is an arbitrage opportunity? It is an opportunity where you can benefit from a difference in pricing. Isn't that what we talk about arbitrage as being? What, in principle, looking at these prices for McDonald's, what would we say is a potential arbitrage opportunity, okay, in the Big Mac world? Can anybody think of a play you might be able to make, okay, a financial move you might be able to make to take advantage of this mispricing? What would be the scheme? One possibility is that you buy Big Macs in China, okay, you stuff them in a suitcase, and you ship them to the United States. Does everybody see that? And you then stand outside a McDonald's restaurant in the United States, where you know people want Big Macs, okay, and you sell them for a price higher than $1.83 and lower than $3.57. Okay? And that if enough people did this, the anomaly pricing would clearly go away. Okay? Does everybody get that idea? Okay? Now, why in the case of Big Macs does this not happen? Why isn't there a market in shipping Big Mac sandwiches around? Okay? There must be a reason. What is the reason? I think it's self-evident. One would be transportation. The other, I would probably say, is durability. Okay? It's not clear that the Big Mac made in China, by the time you ship it to the U.S., is as valuable. Okay? Does that make sense? But I ask a question here that kind of governs better what we were talking about. Suppose these mispricings, instead of being McDonald's sandwiches, had to be gold. Okay? Suppose gold was costing half as much to buy a bar of gold here in dollars than it was back in the United States. You can be darn sure that there would be an extensive shipping, smuggling, arbitrage type operation. Okay? To buy gold here and sell it in the United States and convert those things into dollars and make a big profit. Does everybody see that? So the world of gold, I guarantee you, is not as lopsided as the world of Big Macs, because there are these arbitrage opportunities that are taken advantage of in one market that can't be taken as well as advantage of in the other one because of issues of storage costs, of stuff like that. Any questions about that? Okay? So again, commodities differ in their physical properties. This is why actually it's the theories related, or the pricings of financial things like stocks and gold and things like that, okay, are, you know, much more obviously governed by our theory. Any questions about Big Macs? anything like that. Okay. One other thing before I get into the lecture today, we'll continue talking about options, but one option while I remember it I want to check. There is a chance I may need to be out of town at one point during one or 2 points during the semester. And I understand there's different ways of dealing with it here, okay? One of which used to be popular, that I gather is less popular now, but I know is potentially legal, is running 2 classes back to back. What I would like to see now is, I'm going to turn my back to the board, okay, and I'd like you to take a count as to what people say, okay? How many people here would have a problem, like they have a conflict, if there is another class, if we had scheduled another class right after this one? In other words, has a conflict between now and noon? Raise your hand if you have a conflict between now and noon.
And you have a class at 10:30, raise your hand.
Okay. How many of you do not have a conflict at 10:30? Okay. Is this down? Can I turn around? No? Okay. Okay.
Okay.
Let's take a, what was the vote?
6 have a conflict and 17 do not.
Okay, I will file that away and we'll see whatever that means later on. Okay? Any questions? Okay. Let's get back to options, because that's really now the bigger topic that I'd like to get into. We introduced what options were. Okay? There were securities where you had the right to buy something, but not the privilege, but not the responsibility. And there are 2 main kinds of options we will be talking about in here. I mean, we talked about call options and put options, and that we'll talk about just to refresh our memory again. That's whether you're betting something's going to go up or go down. But there are 2 technical kinds of options that we're going to worry about when we start talking about pricing them, that we better get familiar with the lingo now. An American option is an option that you can exercise at any time prior to the expiration date. So what is an option, the way I normally think of as an option? You will say, I will buy a call option on Google. What will that say? That will be parameterized by a strike price. At what price could I buy this Google? And a date until, right? I can buy, maybe I'll have a strike price of Google at 600. That means that I have the option to buy Google at the price of 600 anytime between now and, let's say, December 15th. Okay? In an American option, I can exercise that any time in this interval. In what they call a European option, there is an expiration date, but I'm only allowed to execute it on the expiration date. Okay? So again, if we were to draw a picture, a calendar here, here is today, here is the strike price of my option. This is the date. It goes from today till the expiration date. Okay? The strike price, the actual spot price can go up and down. Okay? With an American option, I could buy it any time in this range. At any moment I say, yes, I want to buy this stock at this price. I could buy it here, 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 here. With a European option, I am only allowed to buy it there. Okay? Any questions about that? Which option should be more valuable? If I give you an option, a call option, I give you the chance to buy a call option for Google 600 expiring December 15th, which one should be more valuable? An American option or a European option?
American option.
American option, right? You have more options. That's, I guess, one way to think about it, right? So, American options have the property, first of all, that they're more common. Second, that they are more valuable. Okay? But we will quite often talk, yes, question.
But for European option, you can sell it. You can sell the option when the price is lower, before the expiry.
I'm allowed to sell my option, assuming it's an exchange-traded option.
Yeah, so...
I'm allowed to sell my option. But there's a question of whether I'm allowed to execute my option.
But if the price is lower, you can sell it to make a profit.
If the price is lower, Okay, so one thing that you could say, what happens if the price is here, I own a European option, and then my daughter gets kidnapped. Okay, I need money fast, right? This option clearly, although I can't actually execute it and turn it into stock till here, right? It clearly still has a lot of value to it, right? And I could probably sell it to someone. Okay? So if it's exchange traded, maybe the differences are not as much as you might think. Okay? That's probably what you're arguing, right? And that may be reasonable. The reason we're going to talk in here about European options quite often is they turn out to be easier to find the right price of than American options. So you're arguing they're not that much different. And I'll argue they're not so wildly different. Although it's obvious the American one should be worth more. When we get into the theory of pricing, it turns out the theory of European options is easier than American options. So we might talk about that. Okay? Any questions about that? Okay? Yes?
When they execute the American options, the amount of options left in the market drops, right?
Excuse me?
I mean, the options in the market is a fixed amount. Then if you execute,
okay,
then the amount drops, and according to the demand and
supply and demand. Okay, so that's an interesting question. So first of all, you're saying to me, if I decide to use one of my options, to say convert it to stock, that's true that there are less options outstanding on the market, right? Okay? And that might cause a supply and demand issue if everybody were to do it, right? Because let's say I absolutely really want a Google option, okay? Want to put it on my wall, I collect them, okay? If it's the only one left in the world and there's two people who want these options, then by supply and demand that would put some kind of pressure on it, okay? And that's probably true, okay? Now when we talk about on some markets, people can create new options at any time so long as you find someone to take the other side. Right? Remember, there's a put and a call, and they're sort of complementary. It's not clear that certain markets don't permit you to infuse more of these later on if there was a great deal of interest. Okay? The other thing that we'll see when we talk about the theory is it's usually not desirable to execute an American option earlier, even though you can. Okay, and we'll talk about that a little bit later, why that is. Okay, it's usually better to sell it, as this guy wanted to do. Okay, any questions? So the supply and demand issue doesn't really come in so much. It's more like there's a right pricing issue here, because the supply and demand follows from whether or not they're good values. Does that make sense here? It isn't like someone wants to own an option because they want to put it on their wall. They want to own an option if it's a profitable security to have, if it can be bought at less than its value is. Okay? Any questions? Okay, good. So, in general, things are American options. We may price European options in here just because they're easier. Now, one other kind of option that my students always hear about are employee stock options. How many people have ever heard of these? How many people have them? Does anybody here actually work and have one? Have any? Couple people, okay? So most of you don't have jobs or not at these kind of companies. What is an employee stock option, just since you have these kind of issues? Basically, a company issues stock, shares. It can, in some sense, do what it wants with its shares. One thing it might very well decide to do is give certain numbers of shares to its employees, okay? Or in particular, what is more common is to give stock options where they will say, if you sign on and agree to work with us every year for the next 4 years, we will give you an option to buy 100 shares in our company at a price of $56. If the price is above $56, then this is a good thing. They gave you money, right? If the price of the company dumps, let's say you got these options from Lehman Brothers, okay? These options are not so valuable now, correct? Okay? So one of the good things is, so employee stock options are offered for a bunch of reasons, okay? One reason is because in principle it makes your interests aligned with the company, right? If you work for Google and you have Google options, you want Google to do better, right? You will work harder. Other reasons why Google companies will give you stock options instead of money. There are tax reasons, there's other reasons for companies why this might be a better thing to give you. Okay? But one interesting thing about stock options that they give you is that when you think about what is the value of an employee stock option. Okay? You work for a company, I know you have a small company that you have options in. Is this correct? Well, yes, right? Your company is not traded on an exchange, is it? Right? Your company is probably too small.
Let's say that, yeah.
Okay, let's say it may not be true. Okay, a lot of companies you get options in are too small to be traded on an exchange. If you can't trade it, and all you can do with your options is execute it, the value of your option in some sense would sort of be near zero, unless the company's stock is above that. Does that seem right? You can't do anything but keep it or trade it in for company stock, right? Your option really has no value to you, okay? Or nothing you can do with it, okay? Until the stock gets above that price, right? Now, one thing that Google did recently, which is kind of interesting, is if you work for Google, when you get options, you can keep the options, you can trade it into Google for Google stock, or they created a special market where people can buy and sell Google options. Okay? Google employee stock options. This is an unusual thing, but turns out to be a very clever thing for Google to have done. Why is that? Your options, which you couldn't trade, have a certain value, right? If you could trade it, if you allow people to trade it, to buy and sell it, does it potentially have more value? Certainly it does, right? Because maybe there's somebody else who wants your options, okay? Even though they're not yet above the price that you paid for them, okay? You're paid to execute them. By creating a market in these options and permitting them to trade, in some sense, Google made its own options more valuable to its employees, okay, without in principle paying any more money, okay? Any questions about that? How people sort of get that? How people don't get that and want to get it? Okay? Nobody. Okay? Okay, so let's think about an option. And let's start to think about how you price options. Okay? Suppose, let's say, I have a call option that permits me to buy it. Okay, it's an American call option. Okay? If I own a call option to buy a stock, okay, at $100 a share between now and December, that's what an American option would be, right? Suppose the stock strike price, the spot price is now $110. How much is that option worth? Okay? Let's think about this, because this is a little more subtle than might be clear. Okay? Here we are now. The current price of the stock today is at $110. My option to buy it is at $100. Okay? How much is that option worth? Okay, I can execute it any time between now and, let's say, December 15th. Okay? Is it worth at least $10? Is it worth $10? Okay? Why is it clearly worth at least $10 for an American option? Okay?
You kill it now.
Right, because what I could do is take this thing, immediately say, give me that $110, here's this and $100, give me that $110 share stock, I will immediately sell it in a blink of an eye, and I will have $10. Does everybody see that? Now, is it worth only $10? Okay, that's really now the more interesting question. Is it potentially worth more than $10? Okay, and the answer is yes. Why is it worth more? Okay, because it might very well, I am in some sense betting when I own this thing. First of all, what would we expect time value of money wise? Forget about, let's say, the prospects of this company. Let's say it's got neutral prospects. What would we expect the price to be then? Okay? Certainly by time value of money, you put it in an interest rate, right? We would expect that the price of the stock back then will be higher. Okay? But is that money back then going to be worth more than the money back now? The $10 now? No. Right? Does everybody agree with that? That time value-wise, if you say if all that the difference was, had to do with the fact that we expect that there's a certain natural increase in stock prices, right? That by itself would not justify a higher value than the $10, right? But there are other reasons why this stock might be more valuable, okay? Why this option might be more valuable than just $10, okay? And the way I think about it, let's think about, I give you a chance. I'm going to give you two possible portfolios now, okay? I'm going to give you $100 and, an option for to buy it at $100 now, and an option to buy it $100. A call option for $100. Okay, or I give you 1 share of stock. Right? Certainly, at this instant, I could turn this into 1 share of stock. Does everybody agree with that? But is it possible that this is worth more? Okay? Why might this be worth more? Okay?
Less risk.
Well, less risk is one good reason. What is going to be happening? Suppose I want to own this share for my retirement plan. Okay? And I'm not going to retire for 20 years. Okay? I'm going to want to hold this stock. If I buy the share, what might happen during this time? Okay? There is some chance that the stock price might drop. Does everybody agree with that? If I have this thing, and I really want to own the share, okay, this is still worth it to me, right? Because what am I now going to do? I will now pay only the I'll only pay it dropped to $80, okay? I am now going to only spend $80 of my $100 on that, right? And now I've got the share of stock plus $20. Does everybody see that? So as a risk protection, it is better to have the option to buy it at that price. Because now suppose it does go up wildly, right? What do I now have? I now have the share, because if I have this portfolio, I still have the share. Plus I also have the interest. Remember, I could have put that $100 in the bank. Does everybody see that? And at this time, I would have had $104, let's say, by the time I had that, right? And I could pull the money out of the bank. And I would have the share and the $4 of interest if it's higher. If it was lower, I would have the share plus the $4 of interest plus the difference in the price because it went lower. Does everybody see that? So this option is clearly worth more than the $10. Okay? That's the interesting thing to see here. Okay? What it's worth seems to be kind of complicated, doesn't it? Okay? It has to do with something about what all these trajectories are. If I knew the probability distribution, like here's how I could price this option. If I knew the probability distribution for what the price would be at this time, right? What the probability is it was at this price, this price, this price. Then that would help me figure out what the price of it was, right? But that's a more complicated thing. It should be clear, and it's important to be clear, that the value of this option is greater than $10. Okay, how many people see that and understand why? People don't see it and want me to try it again. Any questions about that? Okay? Now, suppose I have an option, a stock that is selling for $90. Let's now go back to this same, maybe I'll use a different color marker to prove that I have it. Let's say that the current price of the stock is at $90, right? My strike price is at $100, okay? I have the option to buy it at 90 anytime between now and December 15th. How much is this option worth? Is it negative?
No.
Can't be negative. Why not? Because it's an option to do it, right? I don't have to do it. I have the option to jump out that window if I want and fall 4 stories to my death. But because I don't have to take it, okay, my value is not lowered by having this option. Is that clear? Okay? Is the value of this option 0? Okay? The price is $90. The current price of the stock is $90. The strike price on the option is the current price is $100. The strike price is $100 on the option. The current spot price of the stock is $90. Is this option worth 0?
Maybe not.
Can't be negative, but it's worth more than 0. Does everybody see that? Why does it might it be worth more than 0? Okay? Well, because there is always a chance it will get up above the stock price. It's got plenty of time, right? Suppose someone came up to you and said, I want to give you an option to buy a Lehman Brothers share at $100 a share between now and the end of the month. What should you say? Thank you, right? Okay? On the other hand, you shouldn't weigh it worth too much, right? So you shouldn't bank on it too much, right? But it's clearly worth more than 0. Okay? Any questions now about this? Okay? So we get some kind of bounds on the price of what options are. Okay? Through this kind of analysis. Okay? It's a little counterintuitive. What if the strike price was $80? Let's go through this exercise. Would that option be worth 0? No. Would it be worth less than the other option? Yes, but certainly still not 0. Okay? Any questions? And the complicated problem that drives, let's say, a lot of what we call quote-unquote computational finance is, what are one of these things worth? Okay? Because this is clearly now a more complicated security than stuff that we have been talking about so far. Any questions? Okay, good. Okay. Let's look again a little bit about what you can do with options. Okay, we now agree, we know sort of what an option is. To think about it, let's now start trying to talk like a trader. Okay? Traders talk about, am I long or short in something? Okay, there's a security here. Am I go long or go short? Long position in the security is held by the buyer. So if I buy a call, I am long in that call. If I buy a put, I am long in that put. Okay? If, on the other hand, I have sold some the security, then I am in the short side of it. Okay? Be it a stock share, a put, or a call. Okay? Any questions? The interesting thing is that in the case of an option, if I sell an option, the place where I make my money, okay, is from my sales price. Right? Okay? That when I sold an option, I got some money to you. That's what selling something means. Right? And the value of and from then on, okay, I am going to hope that my option, I do not have to pay off for my option. Okay? Here we see the prices functions, the profit functions for people who go long or short on a call. Which is the curve for the long position on the call? Where you actually bought the position on the call. Okay? Which line represents that? The upward looking hockey stick. I don't know how much you guys know about hockey here. Ice hockey is probably not so big. Okay? In America they would call this a little bit like a hockey stick, just because of the shape of it. But what is it showing me? If I have a long position on a call at $50 a share, okay, my profit as a function of the strike price is negative up until $50 a share. Why is that? Why is it? Okay. So if we plot my profit, if I buy a call, if I take the long position on a call, and the strike price is $50, okay, it shows you that I have a negative profit here of $10, okay, if the strike price was less than 50. What does that mean? Why is it 10? Okay? It means that I paid $10 for that option. Does everybody believe in that? We talked about the guy from Lehman giving you the free options. Okay, but you pay for them, right? So, if you buy a call, your profit was, if it didn't finish in the money, was, you had a loss of the price of the option, which was here $10. The guy who had the short position in the call, the guy that sold it, you gave that money to them. Is that clear? And so they have a profit of $10, so long as the strike price is less than 50. The price at execution is less than the strike price, which was 50. Does that agree? Then if the prices go up, you start making money linearly, and they start losing money linearly. Remember, the sum of these curves have to offset each other. Because either I'm giving money to you or you're giving money to me. Correct? So the long position profits once you get past 60. The short position takes a loss soon as you get beyond 60. Any questions about that? Long and short, what the price of the option is. Which is it better to be, long or short in this? Okay? Well, it depends upon what the strike price will be, and no one knows that, right? So hopefully, though, that they have that $10, if $10 was the fair price, then nobody knows it was an equal deal, right? On the other hand, if it wasn't a fair price, it was mispriced, then somebody got a better deal of it. And what happens? Well, we won't know until the end of the day. Okay? Yes?
Is the option then by in a short position or just sell?
Excuse me?
It's just the option, right? So
Well, no. This is what it costs to, when I buy an option. Okay? You can't say, here's an option. Yes, there's an option to buy Google at 500. Let me decide that in December if I want it. That's not the way it works. If I want to have the option to buy Google, then I've got to pay now, right?
this is all the spot price.
So this is showing me at the end of the deal, the x-axis is the spot price. The y-axis is my profit on the entire transaction, which included the cost if I went long on the call. I had to have paid somebody for the call. And then I see what the price, I will then execute it or throw it away, depending upon what the spot price is then, right? Likewise, if I sold the call, if I was short on the call, I would have a profit on the deal so long as the price back then was less than $60. Greater than that, I took a loss. Okay? Any questions? And I guess since I got the money for the call now, right? I got that $10 now. I probably also put it in the bank. I got to do something with it. Okay? Which may have me a little more value. Any questions? Okay? Now what about a put? Which one of these is the long position on a put? A put, remember, is that you're betting that the price will go down, right? The long position on the put is the upper graph, right? What was this? It looks like was a put that was sold with a strike price of $50, where the price of buying the put was $10. Why $10? Because that's where this line is, right? So in this case, the person who sold the put, who went short on the put, the short end of the put, okay, got $10 and was happy so long as the price stayed below above $40. The moment it went below $40, they were in a hole. Okay? Any questions? Yes?
So the seller is actually not doing option, right?
Excuse me?
The seller actually is not doing any option. He actually gives the option to people.
Right, so the seller does not have an option. That's an important point. The seller on the short end has to live up to the contract, right? He is forced to buy, if he sold a put, he is forced to buy the stock, okay, at the price of $50. Whenever the guy who owned the put, who took the long end of the put, says, I'd like you to sell it to me, to buy this share from me, right? If the price of the share went down to zero, like Lehman, suppose, let's say that I had sold a put on Lehman at $50, okay? What could that mean? Well, somebody else, the guy who owned this put now, could come to me and says, here's a share of Lehman, which is worthless. I would like you to give me $50, and here's my option. Give me $50 for it, like you said you would. And he has no choice but to do so. Right? Any questions about that? So the buyer of the option has the right, but not the responsibility. The seller certainly has got the money, he has the responsibility. Any questions?
So the buyer of the put must buy the stock at $50 or can't?
No, the buyer of the put, the buyer of the put, the buyer of the put, a put is the right to sell it. Okay? So the buyer of the put can sell it at $50. Okay?
Can he force the
He can force the buyer to do it. If I own this put option, I have the option to sell this thing at $50. Okay? So if the price was $20, okay, I can go to you and say, you sold me an option to sell it to you at $50, give me $50 for this thing. Okay? That is why this guy is going to make, the owner of the put is going to make a profit the lower the stock goes. Why is that? Because at that instant, he can go on the spot price and buy a share. How much do you think you want to buy a share of Lehman for now? Zero, or probably it's not quite zero, but it's awfully close to zero right now. Okay? Let's say I'll give you $1 for it. Okay? But if I have the ability to, if I have an option, if I own a put option, I have the option to sell it to you, to this back to the other guy for $50. I will clear the difference between these two, right? And that's what this line is showing me. The difference between the strike price, which was 50, and the spot price, which is what's on the x-axis, shifted below by the fact that I had to have paid you for this, the guy who I paid that option for. I paid him $10 up front, okay, for the right to sell him the Lehman at 50. So the real way this should work is, if I own a put, if I'm long in a put, if I own a put for Lehman at $50, I can go to the guy that sold it to me. I can say, here's the worthless share of Lehman. Here is my option. And don't feel so bad that you owe me this much money. You did get $10 for selling me the put. Remember that?
Yeah.
Okay? That's what you should be telling him. Any questions? Okay? Any questions about how this put works? The reason I would sell a put is what? Why would I sell a put? Why would I go short on this? Okay? Is because I think this part of the curve, integrated over probability, is higher, worth more than this part of the curve, integrated over probability. Does that make sense? Okay? And if I'm right, it's good. If not, well, I'm sorry. Okay? I shouldn't have written this thing in the first place, but I sold it of my free will. Okay? Any questions? Yes?
How do the seller of the option hedge their risks?
How does the seller of the options hedge their risks? Well, in the case of Lehman, not very well. Okay, it would be one argument here, right? So one possibility is that you make a deal and you just take the risk, right? Okay, so long as there is enough, you have enough security and you can convince me that you can pay. It's okay for you to take that risk. That is one possibility, right? Another possibility is, suppose, let's say, I am concerned about the risk. One possibility I could do, okay, is, let's think about what I could do, okay? In the case of a put option here, okay, I'm going to lose money if the price is going very low. Is that right? What could I do to get money if the price is going to go low? Another thing I could do is short the stock, right? So another thing I might do at some point is to short the stock by borrowing a share from somebody and trying to do that. That's another operation I could do. Okay? But again, in principle, they should offset each other. Okay? So it's not clear that so that's the danger. Maybe that's easier to explain actually on a call, because maybe short seem kind of funny. Suppose, let's say I wrote the, I wrote the call here, and I sold the call to you. And I'm getting nervous as this company seems to have invented something, and its price keeps going up and up and up, right? Here, let's look at what's happening. The stock price, this is the strike price. The price is here when I sold it to you, right? I'm feeling good, but the price goes up. Still feeling good, right? Feeling, well, now I'm starting to be nervous, right? What could I do? I could right now buy the share, right? I know this guy is probably going to want to buy the share from me at that price, right? One way I can cut my losses would be to now buy a share and keep hold of it in case he goes and, the price keeps going up, okay? The gains on me having the share will offset the future losses on me selling the call. Does that make sense? And again, the mechanism with the put and shorting it is just the inverse of that. It's not any more complicated. Any questions? So there are things in principle I can do by buying share and selling shares to help hedge this thing. Any questions? Okay. Any questions? So what good are options? Let's think about that a little bit more. Okay? If I'm a hedger, why might I want to use why might I want to own an option. Okay? Suppose I own a share of stock and I'm afraid it's going to go down. Okay? Suppose I own a share of Google now and I'm afraid the next couple months will be rough for Google. Okay? And I want to minimize the risk of this. What can I do if the price of Google goes down? What's going to happen to my profit? It decreases linearly, right? What could I do to hedge my risk against this Google share that I own?
Buy a put option.
Buy a put. Does everybody see that? If I buy a put at this price now, what's going to happen? Every dollar the price goes down, my stock is worth $1 less, but my put is worth $1 more. Everybody see that? What would a portfolio of, what would be the payoff of a portfolio of one share of Google with also owning a put? If the price goes up, my share is going to go up in value, right? How much am I going to get from my put as the price goes up? I went long on a put, right? How much is my put going to pay off if the price goes up? 0, right? But what's going to happen on the other side? Okay?
Sorry, I just you said, I thought long on a put was writing a put.
No, long on a put means I have the option to. Let's go back to this. Let's go back and see what it says.
Put means buying a put?
Long on a put means that I am the buyer of the option. Okay? A put option says you have the right to sell it at this price. Does that make sense? Okay? I find this very confusing. Okay? At least the nomenclature. But the basic idea, if I buy the option, I have the option to sell it to you at this price. What is going to happen now as the price drops? I am going to be taking a loss on my Google equal to what? The gain on my put, right? What is the sum of them going to be?
0.
So now by buying this put option, I have protected myself if something bad happens to Google, right? What's the cost of this to me? Okay? It looks like this is great, right? I get no losses, but I only get gains. What's missing here?
The price.
The price of that put, right? What the put wasn't free, right? So really, what would be it be like is this is really like minus $7. Okay, this would be 0. Okay, because I am always paying for that put under this scheme. Okay, any questions? So I can use an option to hedge, and that is a valuable thing, right? I can use my options to speculate. Okay, I can say I am going to buy a call option because I'm so sure that Google is going to go up, that if Google goes up, I will make a great deal of money, right? An arbitrager is going to say, wait a second, people can buy and sell options, they can buy and sell stocks. The more things that are being bought and sold, the more likely one of them has the wrong price, right? Like the Big Mac here in Hong Kong, okay? And there's then a buying opportunity for me to lock in a profit if something is mispriced. Okay? Any questions? I think the biggest thing about it is, why might options be better things for arbitrageurs to deal with than some of the other securities we've talked about? What did we talk about the prices of options? When I asked you how much was an option worth, remember we said that it was obviously more than 0, okay? But it was hard to put a correct price on it. the harder it is to put a correct price on it. The more likely it is someone smart can put a good price on it, a better price on it than you can. Does that make sense? So this is one reason why arbitrageurs can get excited. Also, I guess speculators, a smart speculator, okay, in principle, the more complicated it is, the more likely they can take advantage of it. Any questions? Okay. But let's look at one reason why investors might hold, and this is more like speculators, might prefer options. Why would you want to hold options, perhaps, buy options instead of buying a stock? If we think that, let's say, IBM is going to do well, I have two options for what might happen to how I can profit from IBM doing well. How can I do it? I can buy IBM stock, right? Or I could do what? Go long on call options, right? So which is a better thing to do? Well, let's take a look at it. Two possible scenarios, just to get a sense of this thing. Suppose IBM is trading, the current price is $90 a share. Let's say I can buy a call option, okay, at a strike price of $90 a share, okay, and for any time between now and 3 months from now. But this option will cost $5 a share, right? This option seems pretty valuable, right? The strike price is now, it's already at its strike price, right? At $5 a share for the call option, what does that mean? Somehow the guy is betting that over the next 3 months it's not going to get more than above $95, right? The guy who's selling it to me. Okay? So if I wanted to get the power of $10, 100 shares of IBM, what I could do is buy 100 shares. How much will that cost? $90 a share now, right? Want to buy 100 of them? 90 times 100 is 9,000. Okay, am I right about that? Another possibility is I buy 100 options for IBM shares at the strike price of $90. Okay? At $5 per option. Right? Which one did I need less upfront cash for?
Option.
Clearly the options, right? The options are cheaper than the stock. Okay, that's one thing. We have to look at a little into that when we talk about the prices of these things. But here the options are cheap. Let's look at these two portfolios and see what they look like a year from now or 3 months from now. Suppose IBM went up to $100. I bought it at 90 if I bought the shares. It went up to $100. It went up to $100. I've made what kind of profit per share? How much? $10 per share, right? The difference between what I paid it for, what I sell it for then, and what I paid for it, right? I bought 100 of these shares. My dollar profit was 1,000. That's 10 times 100, right? Suppose, let's say, the price went down to 90, stayed at $90 a share. What would my profit be? 90 minus 90 times 100, which is 0. Is that right? And what would happen if the price dropped to $80 a share? What would my profit be? I paid $90 for this no-good stock that is now 80. Okay, I guess my profit is, my loss is, okay, 90 minus 80 times 100, or I lose $1,000. Okay? Any questions about this column, where my dollar profit is? Let's now look at the call options. I bought these call options that will pay off at $90, right? For each of these 100 options I made, Okay, let's look at case 1. I bought the options to pay off at 90, right? No, right, I bought the options to pay off at 90. I have 100 of them. Okay, the price is now, what do you call it? The price is now 100. So the difference between my strike price and my spot price is $10 per share, right? So I will get, for selling these options, $1,000, right? 10 times 100. Why is my profit only 500? I had to buy the options, right? I paid $5 per share for my options, so my dollar profit was 500 there. Now, look at the second case. Suppose, let's say, that the price stayed at $90. I paid $5 per share for the option to basically buy it at, at 90, right? But I can buy it in the store for 90 anyway. What are these options worth? Nothing, right? So my loss is everything that I paid on the options, right? And I lose $500 for that. Any questions? What happens if the price of the stock drops to $80? Now, I still have these options to buy the stock for 90. How much more worthless are they? Well, at expiration, they're every bit as worthless as the options when the stock price was $90, right? So they lose everything, all $500 I paid for these options. But does everybody see that I don't lose more? That's the more interesting question. Because I bought these call options, I can't lose more than my total investment in these options, right? So even though the stock price dropped, I can say, well, it dropped to 80, it might as well drop to 0. What do I care? They can pull a Lehman for all I care, right? So does everybody see where the dollar profits come from? To make sure you understand the mechanism here. The more interesting thing is the percentage profit, right? In the first case, the IBM, I got $1,000 profit on how much of an investment?
90.
I had to buy 100 shares at 90, that was 9,000, right? $1,000 profit is great, but it's only the profit on over $10, but it was a substantial investment. And my percentage return is only plus or minus 11% in these cases. But look at what happened with my, my options thing. I started with $500. If I made a profit of $500, that meant I doubled my money. My return was 100%. Bingo. In my other cases, I was completely wiped out, right? My profit there was minus 100%. Okay? So what's the upshot here? But with options, I can have smaller upfront investment. I can have the possibility of great returns and losing everything. But I can sleep comfortably knowing I can't lose more than everything. Right? I may end up on the street, but no one else will care because I don't owe them any money after this. Right? Does everybody see that? Okay? Which for Lehman these days would have been a good thing. Any question? Okay. See how the options work. Okay? Any questions about how the options work? Why they are good things potentially to buy? Okay? Any questions? The other thing, we still have about 10 minutes. I'd like to talk about now using a question.
Yeah, so by the time you can execute the option, say call option,
Yeah.
what if you don't have the money to execute it? Like, do you really need to have the physical money?
Okay, well, I at that point, when I execute the call option, I need the physical money, right? So it's certainly true that I have an option to buy in this case, IBM at 90. For me to complete the transaction, you have to actually give me the money too, right? So then, what do I do if I don't have the money?
Sell the option.
Right thing I do is I sell the option to somebody who does. That would be the right way to think about it, right? Okay? But yes, certainly my upfront investment was very little. Okay? If I actually want to buy the shares, okay, I do need the money. Okay? If not, I can, as is probably the case in this particular thing, so I didn't say that I actually bought the share. I didn't, either in this particular, in case one, if I own the options, either I had better come up with the money to buy those IBM shares, which would have been $9,000. Then I can sell it immediately and realize my profit. Or I could sell my options to somebody else. Okay? And then I don't need the extra $9,000. Does that make sense? Any questions? Any other questions about this, how you use these options? Okay? What the wins, losses are. Anything else? Okay. The thing that is going to be interesting now, that we're going to want to talk about some today just as an introduction, but more deeply we'll finish up next class, has to do with the fact that how do I use options to do things? Okay? On one sense, it should be clear that I can use options if I think IBM is going to go up. Okay? I can use an option, I can buy options and take advantage of that. If I think IBM is going to go down, I can buy a put option, right, and take advantage of it. Okay? It is possible, if I think IBM is going to go down, maybe I will sell a call option, right? But that might, I'm not, I could do that, right? So there's certain things that I can do if I want to take advantage of, is something going to go up or go down? It should be clear I can do that with options pretty easily. A harder thing to do, though, is to try to combine the stocks and the options in a way that will reduce risk. If we looked at our Google example here, this was a good example of what we were talking about doing. Right? I owned Google. I wanted to protect myself against the risk of Google going down. I bought a put. And now I have a portfolio consisting of a put and a share. And if the price goes up, I win. If the price goes down, well, did I lose? Okay? I lost relative to if I didn't have the put. Right? I would have, okay, well, wait. If I own both the stock, the put, and the stock, as the price goes down, it will be neutral, right? And so I protected myself from that loss. Okay? The question now is, there's a sort of an art or a science here to combining puts, to combining options with shares, and constructing portfolios. So the portfolio has a particular behavior to it. Okay? Any questions about that? Let's look at an example here. And it's pretty much the example that I was talking about before. Suppose I am, it's a slightly different orientation, although the same basic idea. Suppose, let's say, that I own Google stock, and it's selling for $500 a share. One thing that I could do is sell a call option at $600 a share, right? What would the performance of this portfolio be? Here would be my profit of my portfolio. Let's say that this is $500, the current price, right? If I just own the stock, If the stock goes up, I will pay off linearly with that, right? It's not only linear, it's linear with slope 1, right? For every dollar the stock goes up, my profit goes up by 1, right? But if I own my Google and the price goes down, my price profit will be, I will lose $1 for everything that it goes down. Does everybody agree with that? Suppose that actually this is zero. This is my profit. This here is $500. Suppose that now at the price of $600, I sell a call, right? If I bought a call, that gives me the right to buy it at $600, right? If I sell the call, that gives me the requirement to buy it at $600. Is that right? So what would my payoff be after $600 if I own both the share and I sold a call? By selling the call, the guy that bought the call will make money whenever the price got above 600. Is that right? So I will lose money by a conservation of money argument. I will lose money above that, right? On the call that I sold. But because that offsets what I have with the share, this is going to be my profit on the, what you call it? On the, I guess this would be my profit on the call that I sold. But because I own my share and I own the call, what is my total? I sold the call, but I own the share. What is my total payoff function going to be? Above 600, the share I own is going to offset the gains in the share that I own. Will offset what I owe on the call that I sold. Does that make sense?
Yeah.
So my payoff function is going to basically be, if I have a portfolio consisting of a call that I sold at 600 and a share of stock, the real payoff that I'm going to get is going to look something like this. Okay? When I sold that call option, what did I get? A certain fixed amount of money. Is that right? So the difference between the payoff function and my real profit is this fixed amount of money. Right? Let me explain one more time because I think people are losing it here. My portfolio now is, I own one share of Google stock, right? I am now going to go and sell, and it's currently at the strike price of it's certainly at the spot price of 500. Suppose I now sell a call at 600, right? I will get a certain amount of money, let's say X dollars, for X dollars. That means that I am going to have X dollars regardless of what happens in the market, right? If the price stays below, let's think about it. If the price drops below what I have, the call option is never going to get used, right? The call option was written at 600. If it drops below 500, the sucker will never actually execute the call option, right? So then I still own my Google stock and the money they paid me for my call. Is that right? So I'm happier than I would have been otherwise, right? At $600, he now has the right to buy it from me at 600. But that's okay because it's still trading for 600, right? I still have my $600 in Google and his money, right? But once we get beyond $600, what's going to happen? My Google price is going to keep going up, right? But I'm going to have to take all that extra profits and give it to the guy that I sold the call option to. Does everybody see this? So if I sell this, have this combination portfolio, what is the good thing? It is better than just owning a share of Google if the price stays below 600, right? Because I get the extra money for selling the call, right? If it's above Google 600, I still have made money on the deal, right? Only less than I would have if I didn't sell the call, right? So with this combination of portfolio, am I better off doing this than keeping just the Google share? Well, it depends. Okay? It depends. If Google is going to invent a cure for cancer, the answer is no. Right? But I lock in a certain amount of profit over owning just the share. Right? At the cost of giving up potentially some upside gains. Okay? Does everybody see how I can construct a portfolio, okay, out of a combination of owning stock and selling an option to realize certain things? Okay? Any questions? So think about that and look at that and make sure you figure out how that works. Because next class we're going to look at some more complicated patterns of buying options and stocks. So I can profit from all kinds of weird conditions. Okay? And take advantage of this. Any questions? Okay, if not, thanks for your attention, and I'll see you guys on Thursday. Okay, thank you.